Well, hello everyone, and welcome to another ACY Securities webinar. My name is Alistair Schultz, for those of you who might be new tonight, and we will get into it pretty quickly this evening because we do have a little bit to cover on what is happening with the Federal Reserve. But before we get started, we do have a couple of things to go through. So the first thing to look at is this week is pretty much the last week you'll be able to get a 15% deposit bonus if you are going to sign up to an account post the 29th of March. ASIC will be restricting some of these sort of regulations, but we are able to still do it for the time being. Now, if you are intending on getting on, I'd suggest you do so in the near term. Now, as a little bit about me, for those of you who might be new tonight, as I said before, my name is Alistair Schultz, and I am the Chief Market Analyst for ACY Securities. And I've got more than sort of 15 years experience trading in financial markets and operating in a variety of different capacities, from brokers to investment funds all over the globe, which have included some of the trade floors in New York. And I'm a published author as well, which I initially wrote it to sort of help with the coaching that I was doing for students, which eventually has led me to be teaching Tim Cahill at times, as well as speaking on a variety of different programs, whether that be on AusBiz TV or the Australian Financial Review, Sydney Morning Herald, Bloomberg, FX Street, Finance Magnets, and a variety of others, including things like Ticker News. I'm quite actively available on those sort of programs as well. Now, to get into sort of the nitty gritty, I started off with a technical trading sort of background, but I have slowly developed a fundamental and a much more broad range of trading techniques over the 15 years. And it's been a bit of a journey. And I always look at things as a journey when it comes to trading. It's not about what works for me, but it's about finding what works best for you. Now, tonight, if you at any stage would like to have a chat with me, or you want to get in contact with me somehow, then the easiest way to do it is to go through the chat function in Zoom. Now, if you're not sure where the search function box might be, you can use some of the Zoom shortcuts by simply clicking on Alt-H or CMD Shift-H and Command Shift-H, depending on what platform you're using. And it will open it all up on your screen for you, ready to send me a message. So use that if you do have a question while we're going along. I'm happy to sort of answer them, or if you have a chart or anything along those lines that you'd like me to have a look at, I do always enjoy seeing that. Now, if you are watching from YouTube, unfortunately, the live function for me is a little bit difficult to manage with everything else that we're sort of doing while teaching. I can sort of handle one chat function, but being able to keep an eye on both is a little bit difficult. So if I miss it, I do apologize. The best way to get in contact with me, if it's through YouTube, is to leave a comment, in which case I'll check it at the end of the session. Now, if you do the live chat function in YouTube, it actually does disappear at the end of the session, so I'm unable to respond to them and see them. So it would be good if you could do it through the comment function instead. Now, tonight's agenda, it does look like there's a little bit less than normal, but I'm sure we will usually cover the entire time period. Anyway, I'm going to be focusing on the Federal Reserve. Tomorrow, we have a monetary policy, some announcements coming out, and some economic projections coming from the Fed, which last time we saw them was in December. So it is kind of a little bit important, particularly with how much has changed in the last little while. I'm going to cover some of the things that I'm going to be watching in this monetary policy statement. So I am going to be, it's not tonight, it's tomorrow night, but it is an important one to keep an eye on. So I'm going to go actually be watching it on the night and paying attention to what is said, plus reading all the documents in the overnight action. So I will give you a bit of a rundown on what I'm planning to look at. Obviously, I'm happy to go through any of your charts and questions. The earlier you give them to me, the better I will be able to deal with the time management side of things and ensuring that you guys are going to get a bit of a look at what goes on for what you're interested in. Now, when it comes to a chart, it doesn't matter. It can be relatively anything. Pardon me. I don't mind if it's a trade idea. If you just want a second thought or a second set of opinion on a chart, I'm happy to give you what I mark it up from my perspectives and go from that point. Now, before we do get into things, I do have to provide you a risk disclosure warning, so that this statement here basically says that anything that I say along here is not to be construed as personalized advice and is, in fact, general advice. But no matter that, the other aspects of this to really consider outside of this investment risk warning is that if you are planning to invest in things, you should have at least 3 things that you should be able to check off your list. The first one is what your investment objective is, i.e., what do you want to do with that money? The second one is what do you anticipate getting out of it? And of course, what your risk tolerance might actually be for dealing with it. And the third one is your level of experience. Now, if you are finding that you don't know the answer to any of those questions, then please seek some advice to give you a bit of a hand in establishing those so that you can be a bit more aware for yourself and in turn improve your trading. Now, I am just going to put up a chart for us to have a look at, and we'll get straight into what we're looking at. Pardon me, I've got a frog in my throat that's not going so well. Now, looking at a few things talking about the Fed today. Obviously, we have a lot of different pairs that we can actually deal with when trading this in the next couple of days. We have the Aussie dollar, the euro dollar, pound dollar, dollar yen. There's a lot of variety, and there is going to be a bit of impact, most likely, on tomorrow's trading action. So for me, this is kind of one of the things this week that I do have a bit of a focus on to consider. Now, before we jump straight into the Fed thing, I would like to give you guys a bit of a rundown on what's happened in today's market, what we saw sort of a little bit of yesterday to try and give you guys a bit of that, background information that we need. We'll have a look at the calendar as well, just so that we can all be aware of what's sort of happening. Now, to give you guys a rundown, today's market, we saw Asian stocks sort of rising. And the reason for it was there was a bit of optimism in the market today based around, the economic recovery. We've seen shares sort of go to new records in the S&P 500, which is now at another new all-time high, only just about $10 difference between the last one, and the Dow Jones, which has sort of towered away for it as in that sense. Now, the other ones, we even saw the NASDAQ rising again. Obviously, it's not at an all-time high, but it's still very, very near where it was at its all-time high. And we've really been seeing that, this is all sort of being led from clues about what we're thinking about in the outlook for the economy moving forward. We've got a lot of vaccines being rolled out. We've had some bad news on the AstraZeneca side of things with countries in Europe banning it, or not banning it, but at least doing some more research into it before they restart giving vaccinations with it. But of course, there's still 2 other vaccines that are contending for that. And we are starting to sort of see a bit of some more optimism for the idea of the world getting back to a more normal state. Now, whilst that's all been happening, we've seen, with the tech side of things and the stock side of things in general, the S&P 500 has had 5 straight sessions in a row of an advance. We've also seen them being today, the lead was really being taken by utility companies such as electricity and gas and such. And we've also seen real estate sectors sort of popping up and keeping it up. Now, on the NASDAQ, it's really been done via the weighting. Now, some of you might know about index weighting. Apple and Tesla are both the very big ones in there, Facebook as well. And that managed to push the NASDAQ up a little bit higher and brought some of the other stocks up with it, of course. Now, the concern on European stocks, even though we've seen European futures aiming up today, there is some worry that the vaccine rollout that they've been conducting in Europe, which has been pretty slow, and now that they've had this, sort of cut off from AstraZeneca for concerns of it causing harm to people, it certainly puts a little bit of a lid on potential in the immediate moment, and makes us sort of consider, well, what if they were to have another lockdown because they decided to stop using the AstraZeneca vaccine? Now, if that was the case, then, we would have to anticipate seeing, Euro stocks and anything related sort of having a bit of a slip. But of course, outside of that, Australian 10-year bond yields have dropped, giving a little bit more on the Australian stock exchange as well, which I will bring that up for you guys just to have a bit of a gander at. And whoops, not that one. There we go. And so when we look here, it's been pretty flat the last few days for the ASX, and realistically, we could even say that the last couple of months have been a very, very slow and gradual drift upwards. And it's sitting still within that sort of theme at the moment. So I am sticking with that for a while. But effectively, the Australian 10-year yields dropped because we've seen a bit of a pullback in the US rates from last week's sort of big highs. And we've also seen oil slip a little bit today, which has been a bit of an, it's was tanking or was sort of flying up there the other day. And now it's kind of brought itself back to a reasonable level to sort of deal with for the moment. I'm just trying to find it so I can actually put a chart. There we go. Now, here's US WTI. You can see that it's sort of pulled back fractionally. It's not that much. We're talking $4 of difference. And the same side on the UK Brent section, but the drop is a little bit more significant, of about, sort of $6 or so per barrel. Now, there is, a lot of things to sort of consider with oil at the moment. We know that there is likely going to have to be an output increase at some stage, but we won't really get too much answers on that until we hear a little bit more from OPEC, which is still some time away. So for the meantime being, we're really focusing on that demand or the necessity. And now that we've actually got US airlines sort of increasing their flights, Australia ones doing the same thing, at least from a domestic standpoint, it gives us a little bit more confidence that it's probably going to keep going in those sort of directions. The other thing to sort of bear in mind as well, I'm sure some of you are into your cryptocurrencies. If we were to look at Bitcoin now, it has dropped back from its highs yet again. Over the weekend, we saw it reach 61,000, even a fraction just above. Today, it did drop down to nearly sort of the 53, 54,000 mark, but it seems to have recovered a little bit now that we are looking at it at this point in time. But effectively, much of the market's focus this week is going to be on central banks. We have Fed Chair Jerome Powell tomorrow, and the Fed monetary policy statements coming out for Wednesday night. The Bank of England rate decision is on Thursday, and then we have the Bank of Japan on Friday. So there is a fair bit to do on that sort of round. In addition to that, we also have Australian unemployment figures, I believe, and a few other things to boot with it. Now we'll just put a bit of a chart up here for us to have a bit of not a chart, the calendar for us to have a bit of a look at this week. I do like making sure that you guys see this because it may impact some of your trading. For those who might not have seen it before, this is Forex Factory Calendar. It's not a bad source if you're going to be dealing primarily with CFDs and FX. If you're going to be looking at other places or different markets, then I would recommend using some other software or at least some other sort of calendar events to deal with it. Metals Daily is a bad one if you like trading gold and copper and all those sort of things. Of course, there is one dedicated for OPEC announcements as well and oil pricing. And generally, though, you will find some of these on your terminals if you're using more advanced software than MetaTrader. Now, in this week or the action that we're sort of seeing today, right now we've not got a huge amount to deal with. The main one that I'm going to be looking at tonight is actually going to be this one here, the German zoo economic sentiment out of Europe at about 9 p.m. Australian Eastern Standard Time. But both of these economic sentiment reports are a pretty good indication on how businesses are feeling about recovery prospects and the economy in general. They are done quite regularly, so they're a pretty good indicator, at least for Germany, but generally speaking, it will also be across the broader range of Europe, depending which one you're looking at. But usually I just go off the German one because it's pretty similar in most of those countries. Now, the other one to sort of look at in the overnight action will be coming from the retail sales. I'll be focusing more on the core retail sales, which gives us a little bit more of a smoothed effect. And then otherwise, we have the NAHB housing market index, which isn't a bad one to look at. And obviously these ones here are okay. They're yellow impact. So, don't expect them to be skyrocketing price, but they are still somewhat valuable. For tomorrow, just whilst we've got this open at the moment, the GDT price index, that's a global dairy trade index for New Zealand, which is quite important. So if you do trade the Aussie New Zealand or just the NZ to something else, you will want to be keeping an eye on what happens on the global dairy trade index, just because of how much trade actually goes through New Zealand as one of their main exports, being dairy and powdered milk products. So please have a look at those if you are going to at some stage. Now, when it comes to this FOMC economic projections, for us, it is going to be 5 a.m. on Thursday, Australian Eastern Standard Time, but that will be, sort of late in the US session for them. And of course, there's a lot here to sort of consider. And you've got the press conference, federal funds rate, FOMC statement, the economic projections. They are all very, very important. But because it is early in the morning on sort of on Thursday for us and Wednesday night, today's really the only day I can cover it. Otherwise, if it was sort of around here, I would just cover it then for us, or on Thursday for us to sort of deal with in the next evening. So they're definitely ones to consider. CPI inflation will also be one tomorrow for Canada if you trade the CAD, just for keeping a close tabs on where inflation's going there as well, which could very well impact. We are expecting to see inflation rise across the globe pretty well over the next couple of months to years. So they are going to be paramount at this time and age to keep a close eye on it, because there should theoretically be some form of growth better than what we have seen in the last few years. Now, thinking about some of these charts that we've got going on today, dollar yen, Aussie dollar, euro dollar, pound dollar, we can add in a dollar CAD or anything in between. The Fed talk is really where I'm going to be focusing the efforts, like I suggested before. Now, I want you to sort of remember where we were at the sort of March, February last year, right as the pandemic and lockdowns were really starting to kick off. Now, if you think about what the economies were like, we were getting some pretty good numbers. The S&P 500 was at that point in time at an all-time high, which we've now certainly superseded. We had the same situation occurring on the NAS 100, which was just here. And pretty much all markets were in similar sort of boats. Now, there is a very big difference between the action that we saw in March last year and March this year. Last March, the Fed spent their time basically axing rates right down to zero, and they were giving their cash out like Oprah. So the economy is in a very, very different place now. And you can say that that's thanks to 3 vaccines, trillions upon trillions in stimulus, ultra loose monetary policy, and we ended up with recovery prospects that actually moved a lot faster than what the estimates were. We were all anticipating that this recovery would take a lot longer, but thanks to sort of the huge rounds of stimulus, I think, as one of the primaries in the loose monetary policy, and then eventually the vaccines, we've seen bounce backs happening very, very quickly. Now, at the end of the day, traders have really been leaning into higher long-term yields with a sort of scenario that involves the Fed lifting rates well before we envision. So, we're seeing yield spikes happen now. We're getting bond yields sort of bouncing more than we would like them to. And I'm pretty sure I've got some images on that just here somewhere. There we go. We might just refresh that so that we get the closer prices, I'm hoping. Now, either way, these yields have sort of bumped themselves up and down. We saw some pretty high numbers. I'm not sure this is accurate because that's the exact same number I saw before, and I know that there are definitely some much higher numbers than that you can see on this chart here. So if we look at the 10-year Treasury for US dollar, we're sitting at about the 1.6%. The highest it's been is about 1.85%. Which is the one that we want to pay a little bit of attention to. Now, because we are seeing these yields sort of going up, you can see the little curve happening up here. That sort of projection for it gives us a scenario that involves borrowing costs getting higher, and the Fed likely bringing rates up to, or giving a rate hike well before we sort of plan. So currently, the projections are, and what the economic projections from the Fed are for rates to be held near zero right through until about 2023. I'm expecting that tomorrow that we won't see too much in terms of monetary policy changes. I do expect to see Chairman Powell is likely going to be trying to reiterate that while recovery is gaining speed, the bar is going to have to be set very, very high for rate increases to ensure that the sort of lagging areas of the economy have enough time to actually catch up. So he's already done that once or twice. We know that he's made, after our chat sort of last week, he spoke about the idea of developing, or at least saying that yields going up just as there's optimism in the market. And I think he's probably going to try and reiterate that sort of picture. But money markets have sort of taken a different view, where we're sort of looking at our currencies and our pairs that we're already starting to see a little bit of speculation happening in the form that price has been a little bit flat, and that people are kind of maybe perhaps betting against the Fed, which I honestly would not suggest anyone ever do. They sort of see, $2 trillion in fresh stimulus about the rollout, which is the sort of trader expectation side of things, and they're expecting that there's likely going to be growth, and because of that, those inflation expectations will rise with the dollars. And so, from what I can really summarize, they're almost starting to price in tighter policy action by the end of sort of year 2022. So that's going to be something that we have to think about quite heavily. Now, the other one that I'm going to bring up for you to have a bit of a look at tonight, when I can just find, there we go, that one there, is the dot plot. Now, the dot plot is an important point to consider in this metric. Now, if you're not sure what a dot plot is, this is effectively what a dot plot looks like over here. And the Fed uses it as a voting sort of a system, so that it's anonymous in terms of the Fed officials that do vote. They obviously know within the FOMC, and it gives us a bit of an idea on where they're sort of sitting in their stance for rate rises, rate lows. So you can see on this image, I might just make this bigger. So that's not quite what we wanted. You can see on this image, there we go. You can see on this image here how it kind of works. Now, this is from 2018, but the metric is almost identical. And effectively, you can vote, if you're a Fed official, you can vote where you think the rate should go to next. And so we try and look for these wider distributions here where we've got more officials voting. Here in this instance, and if we were to go back further again, you can see that you've got them all almost on the same line about keeping it at this rate, between 2 and 2.5, whilst this sort of moves on depending on where we're looking. Going back to 2018, this is a little bit of a different scenario. But if we were to then sort of move our way and think about that objectively, the dot plot is likely going to be pretty heavily speculated on leading up to the event. Now, whilst we won't know who is actually going to be voting in what direction, what is going to be interesting about thinking about the dot plot is how many people are actually voting. So now, when we looked at the December results, the December economic projections, they're done every sort of 3 months. The December one showed that at least 5 Fed officials wanted to see rate rises by 2023. Now, if we start to see an increase in that number, then there is a bit of an idea that we may end up seeing it sort of end up speeding up the process a little bit. More people wanting to see rates go up higher, and rates hike, then it suggests that they do have a little bit more concern than what they're letting on. And as traders, we're not renowned for being patient, and patience is for the Fed is actually waning quite a bit because we keep hearing the same answers. We're not getting as much clarity as we would like. Now, if Powell pushes back on pricing markets, I think we're likely going to feel that he's in a little bit of denial about tightening policy and the need to potentially do it earlier. So that makes a bit of a statement for us on our own. Now, what am I actually going to be watching on the Fed? And this is where it's going to impact some of your trading. Of course, there's more than one element. I think if we see the Fed stand pat, then we're not going to be seeing I think we're likely to see it affect our markets. And of course, if it goes the other way around, it's going to be the same sort of a result. Now, the first one to that we're going to be paying attention to is, and what I'm going to be watching. One, I'm going to be paying a close attention to these economic projections just in general. I don't expect any policy changes to occur, but in where Fed officials anticipate the economy going is where the value is really going to be. We've had a lot happen since the projections in December. New president, $1.9 trillion in stimulus, plus there's, I think, a $900 billion supplementary stimulus program. private sector commentary could be the key to this one. There's already projections from the private sector in the US that shows, a fair degree of economic confidence moving forward. Now, if it does end up in this report, then its chances are it's going to kind of make an echo of the other reports, which are quite optimistic. And it would mean that we would likely end up with upgraded GDP estimates and improved unemployment outlooks from the Fed. Now, then we move from that into the dot plot side of things. I want to see if more officials are starting to say towards rate hikes. And like I said before, we're not going to know who, but if we see additions to the previous 5 who penciled in the 2023 release, then it shifts the potential for earlier action to actually occur. Now, the next 2 pieces kind of tie in together. I'm looking at the inflation picture. If this gets upgraded, I expect a few jittery investors to actually occur. The ingredients for inflation growth are really front and center right now. And so far, the narrative has really been to hold on to our horses or the concerns. And with purchases so far, it's flipped that break-even inflation expectation curve. So instead of seeing, what we would normally anticipate when we think about inflation, we see, it's sort of moving up this way. So the idea is that at this end of the line, we have our short-term bond yield pricing as a low point. Whilst at the upper end, we have our long-term bond pricing. So these might be 10-year treasuries. These might be 4-week notes. And you would theoretically, for a longer investment, get a bigger return than a shorter one. Now, what we're actually seeing is kind of the opposite at the moment. We've basically got this sort of, I can't draw it perfectly because it is a series of straight lines, but I'm doing my best to replicate it. Effectively, we're sort of seeing this sort of shape happening, which means we're getting fading expectations, but this has all been shifted up. So, if we were looking at a scenario of 0% rates, this has all been shifted up to about the 2% mark as the low point. And that does mean that we have a few jitters could be coming on the bend. Now, so far, that narrative that we've been told in sticking to our guns and just hold on and don't get too concerned about it, it doesn't really line up with what we need to hear. Stimulus has pushed short-term expectations much higher than the long-term, and because we're already above that 2% point with pricing fading into inflation, it leads us into, how are you going to deal with this situation, which means bond purchases. And yields have been a roller coaster ride already this year, and more clarity from the Fed is really, really wanted. We basically want to see if they're trying to preserve the ammo that they have left, or if right now the circumstances are dire enough that it's worth spending the dosh. In one element, I kind of look at it and think they're trying to preserve their ammo, and tantrums from investors about yields are likely not enough to push them into it. But this doesn't mean that they won't do anything. There could be 2 areas to really consider on potential action. In this area, I would probably be looking at seeing them switch to a longer dated treasury or security. In which case, it kind of simulates having a stimulus package getting released for the economy. The other one is using yield curve controls, which is like what we saw out of out of Australia and out of Japan as well. Now, whilst that might be the case, it doesn't necessarily mean they're going to do either of them. And personally, of the 2, I would expect them to switch to longer dated bond purchases than I would expect them to do yield curve control, because they've already said a couple of times they're not all that interested in doing that. Now, the final piece that I'm really going to be looking at is labor market. It's all going to need to be considered. The ideal scenario for the Fed on sort of tempering worries is having it run at full speed. So if the economy is running at full speed, we've got maximum employment and we've got hot, sustainable inflation, then that kind of gives us a good point to stand on. But right now, employment is kind of a flat tire for the market. The longer it isn't running at full potential, the more it compounds, and the more it effectively creates a small economy. So if you had an economy that was in this size, this red box, and then we decided that we really needed to get our inflation levels up, we need to get wage growth up, we need to get everything up, but we don't want to do anything about it, then you end up sort of blocking off a part of that economy that's not functioning so well. So, now your box is only this big, and everyone inside this box is living quite prosperously. They have wage growth, and you end up with this stagnated section on the outside that ends up becoming a drain or a lag on the market. And you just end up creating smaller and smaller economies moving forward each time. So that's not really an ideal scenario for the economy, and it's certainly not what the Fed wants to do. So it makes a little bit for us to sort of think about where it might go next. Now, realistically, if they were to do all of these sort of things, then the option is really implementing those yield curves is not something they're going to want to take into control of. So either way, we've got a pretty interesting 24 hours to pay attention to. We may not even get any changes to the policy. And this is something that is quite interesting to me. It's not often you do hear of it, and I certainly have seen them before, but it's not often that you get such highly speculated on, such wanted FOMC announcement that we have the anticipation that nothing's going to happen, but we are looking for very, very specific details that may influence what we see in terms of projected market movements in the next coming weeks or months. So there's a lot to sort of consider on that front. So now let's move on. I know I've been talking for nearly half an hour already, and I would like to put some charts up. So if you have a chart that you do want me to have a look at now, I'm quite happy to have a bit of a look at it. But as a side note, my expectations on this Fed thing is that if they do nothing, they sit on their hands and they do a low touch environment, this is going to be really, really good for cyclical positions. So if you're trading Dow Jones, or you're looking at reflationary trades, then them sitting on their hands will be quite a good move for those sort of positions. So we'll likely, if they sit still, we'll likely see the Dow Jones go up, or at least that's what I'm anticipating for the time being. But it's all going to come down to how they actually deal with bond purchases, and obviously the rest of those things that we've spoken about. Now moving on, we've got a bit of an idea about what we're kind of anticipating for tomorrow. What does that mean for things such as the US dollar? Personally, I'm looking at the scenario of if they do nothing, then US dollar is likely to rise, because they're going to be an increase in value for the US dollar. But when we'll probably see some of the tech stocks take a bit of a hit. So, that's because borrowing costs are up there, and it's going to sort of sit fairly flat. So the tech stocks may ultimately, because they're not going to get yield controls and that inflation runs a bit hotter, then it would indicate that their borrowing power is going to degrade. So that's really how to sort of think about it, or frame the sort of question, or how you might frame looking at the market in it. When we go to the US dollar side, it's the counter opposite. There's going to be less money supply. So therefore, it's going to remain with a little bit more strength. It might push up a little bit. So if we're going to be seeing if we see them sort of stamp at, and we see those reflationary trades doing benefits, with the US dollar probably bump up a little bit in value, and then we see perhaps some of the high growth and valuation sort of companies take a little bit of a knockdown, then we'd have to consider that in other currencies, such as the pound dollar, the euro dollar, and the Aussie dollar, that we are likely going to see a devaluation on our side by comparison to the strength of the US dollar. And because we don't have a great deal of news this week for the Aussie, that does make a little bit of an impact. And naturally for the pound, and for the yen, we end up with the other side being, we have another 2 central bank hearings occurring this week as well, which is going to be something that we're going to have to keep our eyes on. Now, monthly chart, we're going to stick with the pound dollar for now. I don't mind trading the pound dollar. It is one of my preferred. I tend to be like the majors. So we'll get started. First place of interest, there's one there. Of course, we can always drag it down to the low points, but they're not all that useful to us right this very second. Here is another interesting point of support resistance, at least from the monthly. And then the next one above that is going to be up here. And then you could even put one there where we are sitting right now. We've got, several touches of support and resistance at that point, but because price is already on it, I'm going to leave it alone. And then above that, we're going to be sitting at this point here where we're getting all the touches along there for it. So, we've got this sort of a range to work with when it comes to the pound dollar monthly chart wise. This looks very much like a double bottom pattern. However, this is not in the right place. Realistically, you'd want this low to be on this side. So this is not a perfect double bottom. This is not something you would always consider. You could look at this as the next leg along. And it's ended up playing out as you would expect it to and moved its way up on a monthly chart. So we could anticipate that is probably one that is a little bit more correct. Now, dropping us down to our daily charts, there is a little bit of movement happening on the south side. We've got one peak here, second one there. I'm basically going to be putting a bit of a line across this point here. I might just make that as straight as I can to just sort of highlight there. No, it didn't work for me. Bugger. There we go. That'll do. And basically this point here, right in between these two, this high and then this low, is kind of where our support and resistance line is sitting right at the moment. At least from a daily charts perspective. Now, because we are seeing the European or the euro take a bit of a hit with, the ECB not wanting to do more stimulus side of things, and now we've got this vaccine issue, it's no surprise that from a trading perspective, or a trade perspective, I should say, that the pound has a little bit more upward side value happening. In comparison to the US dollar, this is where we are going to be sitting on our hands for probably the next day. Of course, there will be some smaller opportunities on those smaller time frames, but right up until, I think, right before the Fed announcement, we will be seeing probably a fair bit of volatility. So it's going to be a good time to actually be sitting down and actually trading when the announcements start to go out. Dropping us down to a 4-hour chart, nice double top pattern happening right here from last week on the Thursday, Friday, and then we've got now just sort of this slow slog down. Now, I'm thinking in the interim period, I'm wanting to keep an eye on all of these right now. Trend is your friend. We're in sort of an upwards sort of move over a longer time frame, particularly if we were to go to a daily chart. It's been just up and up and up and up for days on end. So, we can easily stick ourselves with something that fits into this sort of parameter here as an uptrend. Doesn't faze me in the slightest as being out of character for this. And I would also be sort of inclined to sort of stick one across like so that we've got a bit of a support zone happening right now. So bearing in mind that, we have the US thing tomorrow happening, I'm comfortable with the idea of taking a long position at this point in time on the pound dollar, at least from a 4-hour charts perspective. Not right this very second. I'd be looking, I'm looking for a bounce. I want to see price bounce in and around this area, and more specifically off either this purple line, or I want to see it off one of my trend lines, including this top one that's on here right now. I'd be quite happy looking for a reversal around there if we were going to stick with that long-term daily trend line for an opportunity to try and get the next run in. Now, with the US dollar or what happens at the Fed tomorrow, it could go either way. Like if they obviously decide, okay, we're going to announce that we are going to, shorten the projections on when we're going to be introducing rate hikes, and of course, they do decide to taper the bond yields, then I would fully anticipate seeing a weakening in the US dollar, but an increase in pretty much in the tech stock side of things, which would then give us, ample evidence to sort of look for a long position, at least from that fundamental sort of standpoint. From the technical standpoint, right now we've got a bit of a range on this chart. We can stick that as our high line. We'll put this down as a blue one, and then the bottom side right now would realistically be right along there. So, this is a simple play in my mind. Buy from the bottom, sell at the top, and you're going sort of up, down, and then this area is going to add some sort of problem to that. We're going to wait until we get a bit of a bounce off preferably in and around this area. You've got 3 or 4 different areas of stop placement that you can use from, and then work our way through from there. Now, dropping us down to the hourly time frame, it does get a little bit more attractive for seeing what happens here. But because we've got these giant engulfing candles that are just really taking over, I would be holding off for the moment, at least on an hourly or a 4-hourly, and wanting to see a little bit more evidence for it in the near future. Now, 15-minute chart, we are looking, this is, very, very nice sort of image, or at least confidence by building in terms of a bounce. I would like to see it come back down and make a second test before coming back up, breaking the neckline, and then shooting up in this direction would be ideal. In terms of, where might I place of take profit or anything like that, if I do see this sort of move down, bounce, it doesn't break this low, and it does manage to close above this point, then I'm going to be aiming to sort of hit around here, the 1.38609, just for a few pips on the way up. That's about 20 pips. But over the next sort of 24 hours or until sort of Thursday, 5 a.m., I am going to be taking my positions quite cautiously, and I'm also going to be doing them in sort of little snipping clips. I'm not wanting to have a huge position or even have one with, a take profit of several hundred pips until I get a little bit more information directly out of the Federal Reserve for this period of time. Now, 5-minute chart for the quick ones. Again, this is the same sort of play as our 15-minute chart. I'm going to be waiting for ourselves to get another bounce. If I don't get a bounce off that, then the next steps are going to be waiting for this sort of trend line to keep on going up, at least for the moment. So I am going to keep that as a part of my playbook for today. Now, I'm hoping today you guys have gotten a fair bit out of the talk about the Fed. I know it wasn't as chart intensive as it usually is or can be, but I did think it was very important considering what news is going to be coming out and how how much focus there really is on it. I wanted you all to be somewhat prepared for the potential of what the different moves might actually be. So bear in mind, Thursday, 5 a.m. Australian Eastern Standard Time is when the announcements come out. If you're not awake for it, don't worry too much, particularly if you're going to be trading the ASX markets. You will be able to get a quick skip or view of it before the ASX opens at about 10 a.m. So keep an eye on that. The other one that I should mention before we start wrapping up is daylight savings for the US has clicked over. And once we click over here in Australia, we will be having different start times. So mostly through summer, it's a midnight, 12 p.m. American Open. Right now, it's about 11 p.m. Once we click over our daylight savings get turned off, it'll go to 10 a.m. So 10 p.m. I said a.m. the whole way through that. I meant p.m. It'll be 10 p.m. For US Open once that next run of daylight savings kicks in for us. So I will leave you all there for tonight. I know I've been talking for a solid 45 minutes, and you guys might need some time to digest some of that information. Now, if you have questions, I'm always available via a few different channels. Obviously, if you haven't been able to get in contact with me tonight because you might have been using YouTube and you did the chat function or something like that, then please leave a comment there. Of course, I have a variety of other social media areas that you can send me a message through. LinkedIn, Twitter, Instagram, they're all there. So please feel free to chime in and let me know how you're going, how you're traveling, what you'd like to see improved. And of course, what if you have questions about what we might be looking at with the Fed, or you want something clarified, then please feel free to shoot me a message. Now, of course, I'm on AusBiz quite a bit. We've covered that quite a few times, and I do have a few different shows on. Yesterday was the trade, so I'm on the trade, the pulse, and the drop. At the moment, I've only got the timings for the drop up on the screen, but the other ones are between 2:45 and 3 p.m. So feel free to sign up to AusBiz. It's free for you guys to watch, and there is more than just me on there in terms of content. So feel free to join us for one of those sort of events as well. Now, otherwise, I will leave you all for the evening. I do hope you have a great trading week, and I'll be here on Thursday again, same time, 7 p.m. Australian Eastern Standard Time, to review what we've seen from the Fed and talk about that probably a little bit more, as well as looking at what goes on with the Bank of England. So I'll leave you all for now, and I'll see you all next time on Thursday. Bye for now.